Welcome to session 6 of Skills Sprint 2025, a knowledge-driven initiative by JCI Triprayar aimed at learning, growing, and empowering individuals with practical skills for success. Today is not just any day, it's the much anticipated India versus Pakistan clash. And as we all know, when Rohit Sharma and Virat Kohli step into the field together, their partnership can make all the difference for India's chances. Similarly, in the world of financial planning, having the right experts guidance, you can be the game changer in achieving financial success. We are privileged to have two such stalwarts with us today, our very own Rohit Virat partnership of financial wisdom. First, we have Mr. Suraj R, founder of SGFIN Solutions, a seasoned wealth management expert with over 12 years of experience, banking and investments. Having worked at ICICI Bank, HDFC, Standard Chartered, and Kotak Mahindra, he now runs a successful wealth management firm managing over 300 families across India and the UAE. Alongside him, we have Mr. Sandeep S, Regional Business at Kerala HDFC Mutual Fund, who brings 18 plus years of expertise in the mutual fund industry. With a deep understanding of market trends, investment planning, and portfolio management, he has previously worked with Aditya Birla Mutual Fund and will share invaluable insights today. Just like Rohit and Virat strategize to chase victory, these two experts will help you strategize your financial goals and build a winning portfolio. So let's give them a virtual round of applause and get ready for an insightful session. Over to you, sirs.
Thank you, Sudesh. First of all, good morning, very good morning to all of you. First of all, let me congratulate the JCI Triprayar team and led by Krishna, Sidesh, and Stall for taking this initiative. Like I congratulate all of those members because being a Sunday, being a holiday, so a lot of people has joined in. So their initiative it deserves much of applause for this taking this initiative of learning because we know knowledge is power. So as long as we keeps on learning throughout our lifetime, we keeps empowering and we will develop as a person, as a much better individual. So on that note, let me congratulate once again to them, and let me thank them actually, especially Mr. Sidesh for inviting us to take the session today. And let me thank from the bottom of my heart, and also let me thank Sandeep, regional business head of HDFC Mutual Fund, also for supporting us today. And also let me thank all the participants. Even we have participants from outside Kerala, so that's why we are keeping most of the session in English. Like we'll keep a little bit Malayalam also. Like we'll try to keep the most of the session in English. So with that, not wasting any of the time, let me move on to the topic. So our today's topic is, as all of you know, our today's topic is smart financial planning. So first of all, why is financial planning required? Like I used to see, like in everyday's newspaper, I can see at least one financial fraud happening all over Kerala or somewhere else. Even today's newspaper has a incident from Irinjalakuda, which has happened, a financial fraud. So all this happens because we know Kerala is a highly literate state, but when it comes to financial planning or financial literacy, there are a lot of red flags. So to plug that gap, we need to have a better financial planning. So financial planning is required to make informed decisions. All these fraudulent things happens because we are taking decisions without any informations, without assessing the risk part of that. So financial planning is extremely important to take informed financial decisions. So with that note, I'm just taking the session forward. Like I already told you, Sandeep is there, the regional business head of HDFC Mutual Fund. So Sandeep is taking you to the slides, presentations, and all. So let me ask we are moving in a question answer mode. So let me ask the first question to Sandeep. So welcome, Sandeep, on board.
Yeah, thanks,
Yeah,
Suresh. Yeah.
Sandeep. So I have already just done a brief introduction, and
Okay.
so we are without lacking any of the time, we are just moving to the topic. So Sandeep, as we
Sure.
know, today's topic is smart financial planning. So for my first question is, what is financial planning, and what is the difference between savings and investment? Because a lot of people tend to take it wrongly. Like there is savings is different, investing is different. So what is difference between savings and investment, and what are the steps to be considered, steps to be factored in while considering the financial planning part. So with that, I'm just handing over to you. Thank you.
Superb. Good morning, all. First of all, I would like to thank JCI team for this opportunity. And I must appreciate JCI Triprayar for arranging these knowledge-driven sessions. And thanks, Suraj, for asking these questions. To answer this, let me share my screen first. So I'll be switching off camera due to the bandwidth issue. So I'm just sharing my screen.
Sure.
And time is limited, so I'll be a bit fast. Anyway, the question was, what's the difference between savings and investment? So as we all know, money speaks only one language. That is, if you save me today, I'll save you tomorrow. It's not Hindi, it's not Marathi, it's not English. So that is the only language money speaks to us. If you save me today, I'll save you tomorrow. So as a layman, as a common man, what will happen usually? Suppose if the salaried guy, he'll be getting salary in his account on last day of a month, and he'll be spending the most. Ideally, he'll have home loan, maybe car loan, or any other expenses, etc., etc. So with that, maybe 70 or 80% of his income will get spent. Then he'll be thinking about the saving part. But actually speaking, saving is just a prerequisite for investment. So what is the difference between investment? Investment will make you financially independent, I would say. So what is financial independence then? So that means whenever you need money, the cash flow assurance will happen if you are financially independent. So ideally, a salaried class or a common man or a layman, whoever, once they get the salary or once they get the income on monthly basis, first he must save, then he must spend, I would say. So ideally, if in the age of, this is a financial thumb rule across the globe we follow, in your age of 20s, you must save at least 20% of your income. In the age of 30, you must save at least 30% of your income, 40%, then 50% of your income. So ideally, it's just a prerequisite. So what will happen if you are just saving into your, just saving, what will happen? As we all know, bank savings account will give you 2.75 to 4% kind of interest for your bank savings account. But there is a villain called inflation. So inflation will eat all your savings. What is the current inflation rate? Can anyone guess and tell me? Maybe from a financial background guy can. Participants, can you just answer? Do you know the inflation rate of India now? Inflation rate?
9%.
Not that much, sir. But frankly speaking, for the last 30 or 40 years, if you take the inflation rate in India is more than 6%. Example, 100 rupees. Suppose if you're spending 100 rupees for X today, and next year it will be 106. So that is inflation. So inflation is eating up all your savings, and we are getting just 3% or 2.75% from your savings bank account. So then what will happen? Suppose if you're saving, example, 1 lakh rupee, you're getting salary, and 70,000 rupee you have spent, and just 30,000 rupee are keeping it idle in your savings account with 3% interest, and the inflation rate is 6% in India, what will happen? So next year it will be negative, correct? So this is the impact of inflation on expenses. See, today if you're spending 30,000 for your household expenses, and if you're calculating this 5% yearly inflation on your expenses, after 20 years, your monthly household expense will become 80,000. So how will you meet this expense? If you're working in a private company and if you're retiring another 15 year span, what will you do to get this kind of household spending? And just see the impact of inflation on savings. Today you have 1 lakh rupee, and maybe after 5 years, it will become 80,000. And in the year of 20, it will become 35. That means you are buying something today with 1 lakh rupee worth, you'll be getting just 1/3 after 20 years, correct? So that is impact of inflation. So just savings will never give you wealth. So solution is, that is what Suraj was mentioning about the financial, from savings to investment is the next step. So first you start saving. So ideally maybe 30 or 40% of your salary if the age is 30 or 40. So that is savings part. Then converting savings to investment is the next step. So it will work and it will accumulate your wealth, and you work hard to earn money, then just getting the benefit of power of compounding once you start investing. To start investment or converting from savings to investment, the main step is financial planning. So ideally, Suraj is one of the top wealth managers in Kerala. He'll be doing all this part. But let me tell you how it works. So financial planning is the first step is defining your financial goals. Financial goals may be anything. If a guy is working in a private company, his primary goal has to be retirement. So retirement is a primary goal. Second would be kids' education. Maybe next would be house or maybe car or maybe a foreign trip or whatever. Whether it's short term or long term, first you define your financial goal, then assess your current financial situation, then create asset allocation. So that is the third step. I'll be explaining it later. Then invest accordingly. So ideally, a normal layman investor first define the goals and approach a financial consultant, I would say. So if you're approaching Suraj with your financial goals, he'll be doing the rest of the steps. I mean, like the current financial situation, asset allocation part, investment, selecting a scheme, monitoring, reviewing the portfolio, etc. He'll take care. So if you have a best partner with you, a financial planner with you, or a wealth manager with you, or a distributor with you, they will help you to do all other financial planning steps. Ideally, you must have a financial goal first. Then we'll take care of the financial planning. So why is financial planning important? To reach your financial goals faster in a disciplined manner. Discipline is most important thing. As you all know, I mean, if you're going to gym, then what will happen? The very next day, the muscle will not come, right? So you must go there for a year, or maybe for 2 years, or maybe for 3 years, etc. Then only will be healthy. Same as that, you must have a disciplined approach to create wealth. When you're dealing with investments, discipline is the most important thing. And the second would be standard of living will be improved. Your cash flows will be more. So whenever you need cash, then a wealth manager or a distributor or an advisor will guide you when you need the cash, and they'll ensure the cash flows. So the financial emergencies, as we all know, I mean, we had gone through a tough phase in the COVID time. So we all got affected. So when the financial emergencies, what will happen if you have some contingency fund in a building, and they'll give you the money. If you lose a job, then also you'll be getting this emergency fund. And to manage and save taxes efficiently, if you have a proper financial planning in hand, taxes will be saved. I mean, taxes will be managed efficiently. Of course, the last step would be to enjoy peace of mind. So this is the first step of financial planning. Suraj, you can ask me the next question.
Yeah, great, Sandeep, superb. And so just to conclude, it was like we have to move from the savings to the investing part, and we have to take care of inflation while selecting the investments, and you have to invest according to the financial goals. Defining a financial goal is the most important thing, and this is why financial planning is important. So thanks, it was a super explanation. So we are moving to the next question, that as Sandeep told, the next thing is asset allocation. Look, we have a famous saying that don't put all your eggs in one basket. There's a famous saying, we have all heard of that. So that is where the asset allocation comes to play. So asset allocation, as it is told, like we have to invest in different asset classes. So that portion Sandeep will explain in detail. So Sandeep, just take care of this asset allocation part. Over to you.
Of course, Suraj. No. So in this financial planning steps, I have mentioned about the asset allocation thing. So asset allocation, ideally, your wealth manager or a distributor will be doing that part. But then I'll explain what is asset allocation. We all like Kerala Sadhya, right? Kerala Sadhya means it will have, or maybe a balanced thali. So you must think about this thali or Kerala Sadhya whenever you do the asset allocation. So ideally, what will happen in Kerala? People will have more real estate investment and, of course, gold investment. We all like the yellow metal gold. So that is not the proper asset allocation. If you take a salaried employee, so what will happen usually? So he'll be getting a salary in savings account. Then maybe he may have a sweep account from his own savings account to a normal short-term FD, or maybe a chits, or maybe some gold investments in a jewelry shop or something. Ideally, this is what a normal salaried Malayali do. And of course, his liabilities will be more. I mean, car loan or maybe home loan. So if you have a home, then again he'll be buying another house. Example, let me tell you. I mean, if you are investing 1 crore rupee for a villa or a flat in Cochin, how much rent will you be getting? You'll be getting just 20,000 or 20,000 max. So what is the yield out of the investment on annual basis? If you're putting entire money and entire savings, entire investments into a real estate investment, it'll never give you proper financial freedom. So to attain financial freedom, you must do a proper asset allocation. What is proper asset allocation? Example, so next month, suppose if you have a lump sum corpus today, next month is your, or example I'm saying, okay, your daughter's marriage. So where will you invest? You will be keeping it that in a savings account. Suppose if you wish to now, and you're looking for a proper higher education in a foreign country or maybe in a foreign university, wherever. So to build that, if you're taking a bank savings account or a bank FD or an RD, will it give you the proper financial freedom? No. Why? The inflation is at 6% and an RD gives you just 6% of interest. It will never give you financial freedom. So to attain the financial freedom, based on the financial goals, you must fix your proper asset for investment. Just like a vehicle you're choosing for destinations. Example, if you're taking a rickshaw, maybe from Cochin, Palarivattam to maybe Kakanad, or maybe an Uber for the same distance. But if you're traveling from Cochin to Thrissur, you may be opting a train or you may be opting a bus, right? Suppose if you're going from here to Andhra or to Mumbai, you may be opting a flight or a train. But if you're going to Dubai, what will happen? You wish to cover, you're opting a proper vehicle, same as that. Based on the investment goals, you must choose a proper investment vehicle. Then, just like a balanced thali, I mean, if you're having only rice, what will happen? It's not a proper diet, right? You will not be getting a proper protein or a vitamin. You'll be getting just carbohydrates. Just like that, maybe rice you can compare with your bank savings account. So with the savings account, you must have a proper RD, or you must have a proper FD, or you must have a mutual fund or equity or bond, etc., etc. That is proper asset allocation. So I'll explain in detail in the next slide. See, as I told you before, in India, for the last 40 years, 1980 to 2024, average inflation in India was 7.55%. One sir was mentioning about 9% to maintain the inflation level at 4 to 5%. RBI will be maintaining inflation rate in India. So currently the repo rate, banks, RBI is lending the. If it is reaching 5.75, India's capital expenditure will be improving. India's our spending also will be improving. That is for sure. But by the time the inflation also will get improved. So then again, RBI will increase the rates, then decrease the rates, kind of. So we can expect average inflation in India of about 5%. But see, the last 40 years history, average inflation in India was 7.55%. Bank FD delivered 7.97% interest or return. Gold, the yellow metal, we all like, but it has delivered just 10.65% of return. And equity, BSE Sensex stock exchange or equity market has delivered 15.79% return. So please don't shy away from equities. So I'm just coming to the mutual fund part. Suraj, you can ask the next
Thanks,
questions.
Sandeep. Yeah. Thanks, Sandeep. So just like Siddesh told in the beginning of the session, like about the India-Pakistan match, the duo happening, it's like in a cricket match, we know the match, the innings will be built up with 6, 4 singles, doubles, threes, and all. No, it's not like you are hitting all the balls for a 6. So its financial portfolio should also be like that. Like when he told asset allocation, just that remind me that we have bank savings account, we have mutual funds, we have real estate, we have gold. So all these takes care of that 6, 4, 3, 2, 1 part of an innings of a cricket actually. So we should have somebody to hit 6s and 4s, and we should have somebody to defend, take 2s, 1s, and to win a match. So it's just like in the financial, by coming to financial portfolio also, you should have all these in your kitty. So that's why asset allocation makes it very, very important. So we have, as of now, we have seen the effect of inflation in our investments, and also we have to invest according to the financial goals. That also we have learned. So we have to move to the next part where we have to choose investments by taking care of the inflation. Like we have to take care of the investments which has the power to beat inflation. So that we have already learned. So we should concentrate on that. So we all know mutual funds over the last 40 years of time has given around 15% kind of a return, which Sandeep is already showing in this chart. So it is an important part. Mutual as a financial instrument, mutual fund is an important instrument which has the power to beat inflation. So with that note, I'm just handing over to Sandeep to take it forward us to the mutual fund part. So with the ideal financial instrument which has the power to beat inflation. So with that, I'm just handing over to Sandeep to take it forward.
So I've mentioned about the equity part. So what will happen if you if you're directly dealing with the core equities? I mean, during the COVID time, many youngsters came into stock market and they are losing money as well. I mean, 8 out of 10 F&O traders are losing money. That's what we learned from the newspaper. So directly investing with equity, we came to know that equity is the only asset class that's delivered the best return, I mean, the double-digit best return in the last 30 or 40 years and beating inflation. But if you're directly dealing with the stock market and directly dealing with equities, what will happen? So you basically need time and skill to research companies, the macro economic factors, the geopolitical tensions, what are happening in the economy. It'll never happen. I mean, you are an expertise in your own core field. Maybe a lawyer, maybe a doctor, maybe an engineer. So you don't have time to research on the stock market or the macroeconomic factors. So, and moreover, I mean, those who are dealing with the core equity or the stock trading, what will happen? The tendency of higher emotional ups and downs. As a result, stocks are volatile, as you all know. I mean, equity market is a bit volatile. So during that time, if you're a bit emotional, you'll be losing money. So portfolio churning and tax efficiency will never happen in your portfolio if you don't have a proper expertise in your hand. And risk of concentration, of course. Suppose if you have 1,000 rupees to invest on a monthly basis, you will never get a best stock or the better stock to invest. Why? Its stock price may be 1,000 rupee or maybe 2,000 rupee or maybe 5,000 rupee. So you'll be ending up buying small stocks with lesser prices, and you'll have concentrated risk and expertise is not available with you, and you'll be losing money. So to beat that part, you basically need a mutual funds. Mutual funds, what will happen? An expert IIM graduate, or he's an expertise in this field for the last 20 or 30 years. And of course, in mutual funds, you can invest with a smaller amount of 100 rupee, and it'll be diversified among multiple stocks. There you are investing into a portfolio with 50 or 60 or 80 or 100 stocks in that particular portfolio. So easy diversification will be getting with the lower, very less amount you can invest, and you will have liquidity and you will have expertise in hand. Of course, how mutual fund works. So investors pool money and fund managers will manage the money. They'll be deploying into bonds, securities, etc., and they'll return back the money with returns. So key benefits what you get: diversification. Of course, as I told you before, each portfolio of a mutual fund scheme will have 30, 50, 60 or 80 or 100 stocks in that particular portfolio, and you'll be getting a professional fund management. And of course, the accessibility. If you need money or if you wish to withdraw money from mutual fund, you can easily withdraw. T+2 basis will be getting the money. Suppose if you withdraw today, it'll be hitting your bank account within 2 days span. So these are the types of mutual fund, I would say. I mean, mutual funds means people think that it'll only invest into equity and you'll be losing money if you doesn't have time or expertise. No, that is wrong. I would say statement. Mutual funds have two basic category. One is debt. It is purely bond investment, and this is equity. It starts with equity savings kind of portfolio. I mean, it's a hybrid portfolio, and hybrid means it's a mix of bond and equity. So the mutual funds, zero risk investments or a savings means liquid funds and overnight, I would say. Overnight is a zero risk mutual fund scheme. How it works and what is the yield, let me tell you. How you how you invest into a bank? I mean, you'll go there and you'll be starting a savings account, right? First, you'll be starting a savings account, then only you'll be starting an RD or an FD. Same as that, these are the mutual fund savings account. So in a bank savings account, you'll be getting 2.75 to 3% or 3.5%, 4%, whatever. Here in the overnight fund or a liquid fund, the yield to maturity, we will never use a word called interest. In mutual funds, bond schemes, or in the debt schemes, we use the word yield. So how much yield you will be getting out of liquid fund? 7% yield. Suppose if you have just 1 day to invest, overnight fund with zero risk. If you have 7 to 30 days of investment horizon, you can park into liquid fund. There you can expect around 7% kind of yield. If you have 3 months investment horizon, example, as I told you before, your house construction is going on. Your few maturities happened and maybe 30 lakh rupees there in your savings account with 3% interest. You can deploy that money into ultra short term or low duration kind of portfolio. There you can expect around 6.5 to 7% kind of yield again, or plus. Then after that, if you have 1 year horizon or plus short term, then a 2 year horizon, medium term, then the gilt, the government securities, then credit risk fund, etc., or then after hybrid debt funds with just 20 or 30% of equity exposure. That is hybrid debt. So mutual funds start with overnight funds with zero risk, kind of liquid, ultra short term also the same. These are all pure bond investments with an yield between 6.5 to 7.5%. So now we understood what is debt. Then what is equity? Equity, as per the SEBI norms, minimum 65% into equity-oriented stocks. So the rest, 35% can be into bond. So it starts with hybrid schemes, equity savings fund, then balance advantage fund, multi-asset fund. Of course, multi-asset fund, let me take another minute. Multi-asset means, of course, we all know equity, debt, gold, silver, real estate, etc. So all asset classes in one fund. Suppose an investor would like to have an alternate for his bank FD, we recommend these hybrid funds, balance advantage fund and multi-asset fund. If you have an investment horizon of 2 years or 3 years, we ideally recommend these kind of hybrid funds. There you can expect around 8 to 12% kind of return. Then, of course, the large cap funds, the top 100 blue chip stocks are called as large cap fund. Then the mid cap, with the next 150 stocks are mid cap. The next 250 stocks are small caps. Then what is diversified? Diversified fund like flexi cap or a multi cap fund, it will be investing into large cap, mid cap and small caps. Suppose if an investor is coming with 5-year investment horizon or a 7-year investment horizon, and he would like to have only one SAP in his portfolio, we ideally recommend a multi-cap fund or a small cap or a flexi cap fund. It will be ideally investing into large, mid, and small. So all market capitalizations will be there. So which is the highest risk-oriented scheme? Sectorial thematic funds, like defense fund, like banking, like infrastructure, like pharma, like IT. These are all sectors. The thematic means manufacturing is a theme. It'll have several sectors. Consumption is a theme. It'll have several sectors. So a mutual fund scheme with very high risk means sector and thematic funds. So a proper asset allocation, how Suraj or any other wealth manager will do. So ideally an investor will have a diversified funds maximum portfolio. I mean 30 to 50% kind of portfolio will be into diversified bucket. And the second would be hybrid, I would say. 20% to 30% you can have it in hybrid fund. These are the return percentage. Please don't consider this. This is a past return. I mean, it will never replicate in the next 5 or 3 years. This is not the future. This is the past return which the scheme has delivered. This is just for reference. Okay, these are all huge return because the market was rallying for the last 5 years. So the returns were superb. So ideally, as I told you before, hybrid funds will be is just an alternate for an FD or maybe for 3 or 5 year investment horizon an investor has and he's looking for 10% kind of yield return, then he can opt hybrid. So 30, 40, 50% kind will be into diversified like multi, flexi, large and mid, etc. 20% can be in hybrid. 20% can be in thematic sectorial. Thematic sectorial funds usually deliver high return, but it is highly cyclical and highly risky. And lock-in products, retirement fund or children's fund. These are primarily your goals, and you can have retirement and children's for your kitty. 10 or 20% kind of allocation. Ideally, the savings option we need for the emergency contingency bucket. Ideally, 20% of your portfolio can be in the savings option. it'll be delivering around 6 to 7% kind of yield. You can see the yield return, how much they have delivered: 6.68, 6.46, 6.957% kind of return. It has delivered for 30, 60%, for 60 days kind of investment horizon. So a proper asset allocation means defining the goals, and based on the goals, we'll be assigning the proper assets, out of which mutual fund is one of the assets. You can take mutual fund as a key assets to get the proper financial freedom and to create wealth. In that mutual funds, we have multiple scheme options with the starting from the savings, liquid, overnight, then solution funds, hybrid funds, thematic funds, and diversified funds. These are proper, mutual fund categorization. So Suraj, over to you.
So yeah, so in simple term, mutual fund is an instrument which you have all the asset classes. Like you can invest in debt, you can invest in equity, you can invest in gold, you can invest in real estate. So whatever the asset class you say, we have the options in mutual funds in simple terms. Okay, so we are moving fast. So the next thing is, like we know, like when a person does exercise, when he goes for a gym, as Sandeep told, he cannot get the muscles in one day. He need to go regularly. When he do for months, days and years, he used to have a better body. Like that, in while taking care of our vehicle, our car also, we need to do regular service to have a perfect car, to give a better performance. Like that, in investing also, when we do something on a systematic way, something we do regularly, that yields you best results. So we have an option where you can do it in a systematic way, do the investments in a systematic way. So I'm just calling on Sandeep to explain that systematic way of investment in mutual funds. And as time is less, I'm just clubbing the next question also. Like once we do invest in a systematic way, we have a method to withdraw it also in a systematic way. So that option also you can club, so that we can go a little faster. Thanks, Sandeep.
Super, super. So Suraj was mentioning about the discipline part. So of course, to create wealth, we need a proper discipline, as I highlighted in the initial remarks. So we have multiple goals. As I told you before, short-term goals will be the children's education or retirement will be the. So what you earn, what kind of knowledge you have, doesn't matter. The proper equation for wealth creation would be sound investments plus time plus patience. Plus patience. If you're not patient enough to handle your portfolio, you will never achieve your goal. You will never have proper wealth creation. So achieving goals through SIPs. SIP is just an alternate for your recurring deposit in your bank. How a mutual fund SIP works? What are the steps? Whether it's long or short? Identifying priorities a goal. First, you define your goal. Then, example, today's maybe if your kid's engineering education or a medical expense is currently MBBS fees would be around 1 crore rupee or maybe 50 lakh rupee. Example, I'm saying 50 lakh rupee for the whole 4.5 or 5 years. So maybe if you calculate the normal inflation in India is, as I told you before, the past 40 years it was 7% plus. The current rate is nearing 5%. So if you calculate 7% or 5% kind of inflation for the normal household spending, we can take the same inflation rate for the education. Education expenses are a bit high. Lifestyle inflation is very, very high. It is about 10%. So what will happen? To getting, I'm saying the quantifying the goals I'm saying. So current expense is 50 lakh. So we may have to take current, maybe the age of your kid is just 10. After 10 years, you need 1 crore rupee. So that 1 crore is quantifying the goals. If your age is 30, if you want to retire in the age of 50, so you have 20 years span. So ideally to maintain the same lifestyle, Suraj will be calculating the future value of your retirement goal. So then he'll find out the value, the total corpus you need when you retire in the age of 50. It may be 5 crore, it may be 6 crore, it may be 7 crore, whatever. So that is the second part. Then the risk assessment part. So based on the financial thumb rule, I would say if your age is 30, 70% can be into equity. That is the financial thumb rule. If your age is 50, 50% can be in equity. If your age is 20, ideally your portfolio's 80% has to be in equity. That means 100 minus your age can be in equity-oriented assets. But if the age, if a guy is in the age of 30, but he is willingness to take risk is very low, then Suraj will be recommending some hybrid funds. So the risk assessment part is the third one. The fourth one is the investment option, choosing an proper investment vehicle. So he'll be finding out 10 or 15 schemes into that particular portfolio with that 5-bucket principle or different. So he'll be choosing the schemes for your goals. I mean, maybe first or fifth or 10th or bank account, and it will get invested into that particular mutual fund scheme. So what is the advantage of goal-based investment? Clarity of scheme can be for my retirement. HDFC is Y scheme can be for my kids' education. Z scheme for interest, etc., etc. So the clarity of purpose will be there. The emotional management. Suppose what will happen in India, to those who are investing into mutual fund SIPs, they are withdrawing the schemes after 2 years. 50% of the equity SIP investors are withdrawing the money for one or the other reasons. Few people, youngsters, are redeeming for Amazon shopping purpose. Few people are redeeming for house painting purpose. Few people are redeeming for some other short-term recurring expenses. Few people are doing for the proper financial planning as well. So the proper goal planning as well. So emotion management is the another thing. Avoid impulsive withdrawals, as I told you before. People will not withdraw. We know, I mean, in this particular SIP for my kids' education, then you will never touch that particular SIP. And another SIP is for the retirement. So you'll never redeem or withdraw in between. Example, suppose if you're going to Mumbai in Netravati Express and in the Konkan route, it had some engine issue. What will you do? Will you get down from the train and you will take another flight? No. What will you do? You'll wait patiently. So the patience is the key, right? So you'll be waiting maybe for another hour or maybe for 2 hours or 3 hours. You'll be waiting there in the same train and you'll go. So market will be volatile. Let it go volatile. No problem. So you'll be getting more units at that point in time. Whether it's Ukraine, Russia, or any other crisis or geopolitical tension, nothing to worry. Market will survive. If you have clear conviction on India, or for the next 1 decade belongs to India, that this is what we heard from all the newspapers, all from the financial, minister as well. So we must have a clear conviction on Indian economy. We have confidence on Indian economy. Then what will you do? The short-term volatility will never try to pull out the money from the investments, okay? And avoid overspending. So it helps avoid overspending. You will never overspend if you have a proper SIP. Suppose if you have 1 lakh rupee salary and 50,000 SIPs already defined for your financial goals, then you will never spend more than 50,000 from your salary, right? Same as that. And the ongoing monitoring is very easy that Suraj will take care. So best friends of financial freedom means time and money. As Albert Einstein said, power of compounding is the 8th wonder of the world. So how it works? See this? How power of invested with a 10% rate interest, what will happen? With a simple interest, it will become 4 lakh rupee. Correct? And if it is compounding, then it will be getting huge. After 30 years, you're getting 17.4 lakh rupee from your investment. That means 17.4x. But if you're putting in for the simple interest, you'll be getting just 4x. If it is 15%, 1 lakh becomes 5.5. And if it is through the compounding, it has become 60 lakh. So that is the power of compounding. Then next slide will give you a clear picture. Start early, I would say. Start early. See, Ramesh at the age of, he has started early. So he has 30 years of investment horizon. To retire in the age of 50, he has started an SIP in the age of 20. And he has done 5,000 SIP on a monthly basis. We are calculating for the illustration purpose with 12% return. He has accumulated a total wealth of 1.75 crore. But Mr. Rajesh, at the age of 30, he has started, just 10-year difference, okay? And he has invested 12 lakh rupee and he's got only 50 lakh. This is the power of compounding. See another example. In the age of 30, you need to start an SIP to reach 1 crore at the age of 60. But see the 10-year difference? He has to take 3 times of the initial investment, monthly SIP of 5,000 rupee to reach 1 crore. If you're starting with the same SIP in the age of 35. Again, if you're delaying for another 10 years, in the age of 45, you're starting an SIP to reach 1 crore, then ideally you have to save 20,000 per month to reach 1 crore SIP, 1 crore value. See another example of power of compounding. HDFC FlexiCap is one of the flagship funds in India. It has 30 years of track history. NAV of that particular scheme was just In the year 1995, it was 10. In the year of 2003, it was just 22. See, it went up, it went down due to market crisis, due to geopolitical tensions. Before COVID, it was 700 rupee. During 1977. So 1 lakh rupee invested in the year 1995 has grown to SIP in the same particular scheme. If you started 1000 rupee SIP in the year 1995, ideally you must have invested 3.6 lakh rupee into that particular portfolio, and it has grown to 203 lakh. That means 2 crore rupee. So 3.6 lakh has grown to 2 crore. If it was 10,000 rupee SIP, it would have grown to 20.4 crore with a CAGR return of 21.26. In the meantime, Sensex or the index has delivered 14 to 15% kind of return, but the scheme with an expertise of fund manager has delivered 20% kind of return. I'm not saying that the same scheme will be delivering the same return in the next 30 years. No, it will not happen. It may not happen. Based on the market volatility, based on the crisis, it will be a bit volatile. And he mentioned about withdrawal part. How can you manage your mutual fund portfolio for your retirement? This shows, we have an option called systematic withdrawal plan, systematic withdrawal advantage plan, we call it as, and we route it through a dream SIP. It's a normal SIP with particular horizon. See, if you're starting at 10,000 rupee SIP for 20 years, from 20th onwards, you'll be getting monthly 50,000 rupee. If you're starting an SIP of 10,000 for 30 years, after the maturity of 30 years, you'll be getting 1.2 lakh on monthly basis. How it works? See, as I told you before, mutual funds are open-ended schemes. You can withdraw at any point in time. But the only thing is, if you withdraw in between, this dream SIP will get cancelled. That's it. Suppose if you're looking for only retirement, and if you're looking for 30-year investment horizon, how it works? 10,000 rupee investment in the flexi cap fund, as I told you, 36 lakhs become 20 crore. But here we are just calculating for the illustration, just 10% XIRR. And if you are imagining 36 lakh, if it become 2.26 crore, then you'll be getting 1.2 lakh on monthly basis with a CAGR withdrawal, of 6.4% from your total corpus of 2.26. And you'll be getting this 1.2 lakh for the whole lifetime. If it is for 20-year SIP, just imagine 10,000 rupee SIP, you have invested around 24 lakh rupee, and it has grown to 75 lakh in the maturity, then you are getting 5 times of your cost value of monthly SIP of 10. That means 50,000 on monthly basis with the withdrawal percentage of 7.9%. This is a tax efficient manner for managing your mutual fund corpus. So in the mutual funds, just like, you might have opted a life insurance plan for the retirement, but I would personally suggest mutual fund SWP plan will be much better way to manage your tax and your retirement properly. So of course, I would like to cover taxation as well. In the mutual fund schemes, as per the new tax law or the old tax law, all the dividends, IDCW, we call it as IDCW, as per the slab, you have to pay tax. Short-term capital gain for the equity-oriented schemes with 65% equity allocation will have 20% capital gain within a year, and long-term capital gain after 1 year, you have to pay 12.5% on your capital gain. Example, if you put 10 lakh rupee today, and after 3 years, it has grown to 15 lakh. If you are withdrawing 15 lakh after 3 years, then the capital gain of 5 lakh rupee minus 1.25 lakh rupee exemption, then the rest 3.75 lakh rupee will be deducting 12.5% for the NRIs, and for the resident individuals, they have to pay the tax. They are liable to pay the tax of 12.5% on the capital gain, whatever we are getting, on and above 1.25 lakh rupee. Suppose if you are putting the debt funds, as I told you before, the overnight fund or the liquid fund or for the ultra short-term fund, as per slab, you have to pay income tax. So mutual funds will have tax advantage if you're putting your entire money into equity, or if you're putting money into debt, you'll be getting better yield than your bank deposits or your bank savings account, but you have to pay as per your slab. This is the taxation part. Suraj, I think I've taken more time.
Yeah, no problem, Sandeep. It was great. You can just finish off. You can do that.
So friends, we have discussed about various asset classes, as financial planning, asset allocation, different assets, inflation, financial goals. To reach the financial goal, how to invest. You can invest through lump sum investment, single investment, or through SIP, and retirement planning through mutual funds, by systematic withdrawal plan, etc., etc. So concluding today's session with this slide. So first, know your financial position, then know your income expenses, then how much you can invest every month that you decide. Thumb rule, as I told you before, 100 minus age can be into equity. And based on the age, you must save, I would say, to create wealth. Defining the goals is the primary and at most important thing. Defining the goals. Then ideal SIP as allocation, I would say 20 to 30% of your monthly salary or monthly income. Then give priority for emergency fund and retirement. With that note, let me conclude. And if you have any query, then we can have that.
Thank you, Sandeep. Thanks a lot for the detailed presentation. So from the presentation, we can infer that for a smart financial planning, we need to identify our goals as early as possible and invest according to your goals. Start early, do a sound investment, do pick in financial instruments which has the power to beat inflation, invest for the long term, be patient, and the power of compounding will work in your favor. So that's what we want to say in the conclusion part. And I'm just handing over to Sidesh. We have taken just 5 minutes more. I'm handing over to Sidesh to take it forward. Thanks.
Thank you, Suraj. I have shared a feedback form in the chat. Please share your feedbacks about the session. If you have any questions or any feedback to share, kindly unmute and you can have the query. I have put in a query, Suraj, in the chat.
Yes, yes. Shall I take the question?
Yes. Thank you.
Yeah. So Sidesh has taken a question, Sandeep. His question is buying a home or rent out, which is better, and how to decide on this?
Ideally, I would say having a house is very important for all families in India. One house is enough, but to have another house for getting income through that house is a foolish decision, I would say. So to take a very high burden to have another second house is a foolish decision in India, because the return on investment is mere low. I would say it's just less than 4% or 3% kind of. So I would say you must have a proper house, one house to stay for the proper accommodation. That is more than enough. To have multiple house is not good in India.
As he told in the presentation also, he has mentioned about the rental yield part. So buying a flat with a 1 CR and you are getting a rent of around 25K per month. It gives you 25K per month, means you are getting 3 lakhs on an investment of 1 CR, which means the yield is just 3%. So that he had mentioned in the presentation
but
also.
I would like to ask whether buying the first house also is can be categorized like that. Means even is it more of an emotional decision, because
it is more of an emotional decision, sir.
Right.
I mean,
many of a person who has enough liquid fund, but he's renting out.
Correct.
True. So I mean, many people are staying in the rented house. Many youngsters, I would say. I mean,
The
they
new
don't believe in
generation
the physical.
Yeah.
They believe in financial assets rather than physical assets. Those people are investing into equities and mutual funds, and they are taking a proper furnished flat or villa for 25 or 30,000 rupees instead of paying 50,000 or 70,000 for an EMI. And they are staying in a very good premise, and they are saving the entire money into equity and mutual funds.
And we know some great advisors from Mumbai also, Sandeep. You must be hearing that names, Gajendra Kotari and all, who is following this rental model and all.
Yeah. Thank you.
Correct.
True. Anyone else? You can unmute and ask anything if you want to ask. Thank you.
And one more question Sidesh has asked, an ideal time for a mutual fund portfolio review, how frequently you should review your MF portfolio. An ideal time to review the MF portfolio, Sandeep.
Yeah. So portfolio can be reviewed. Few people are reviewing in 3-year span, or few are reviewing in 6 month span or in a 1-year span. So that your wealth manager or financial advisor will do, sir.
Correct.
I mean, just like Suraj. I mean, if you're depending on Suraj, then he'll be taking care of that portfolio part, reviewing part.
Because while we are starting an investment, we decide on a financial goal. So once we decide on a financial goal, it's an ideally we can review on a 1 year or a 2 year basis, so that we can find out if there any underperformance. Because as Sandeep told, mutual fund is a long-term instrument. While we select equity we should have at least a 5 year tenor to have to get the compounding to get started actually. So we should select the funds for the long term, so we can review at least once in a year or once in 6 months. So that depends on the depending on the customers this requirement part. So if there is any other questions, you can use a chat box or either unmute and ask. And moreover, I have mentioned my WhatsApp mobile number also in the chat. So if somebody is hesitant in asking questions, they can later put me in the WhatsApp chat also. We can answer. And also, I think most of you are in that group also, WhatsApp group also, skill group also. You can post the questions in the chat also of the group. We can answer that also.
Any other questions or a feedback? Nirmala ma'am, can you give a feedback on the session?
Thank you, Sudesh, for that opportunity. It's a very good session. Yeah, very good.
Thank you.
For the
Thank you.
youngsters, it's a really good session.
I think you can advise your next generation, your son,
my next
daughters, and all.
Yeah, right. Yeah. I mean, they are not with me right now, so when they are there, I can always direct them to you. Right.
Thanks.
Thank you, ma'am. Right. I will share your number in the group also, Suraj. I will, means if anything is there, they will get in touch with you.
Sure. Thanks again, Suresh, once again.
Right. So what an insightful session on smart financial planning. Mr. Suraj R and Mr. Sandeep S shared valuable strategies on wealth creation, investment management, and financial security. I would like to invite JC Savitwalil to propose the vote of thanks.
On behalf of JCI Triprayar, I extended heartfelt gratitude to our expert speakers, Mr. Suraj R and Mr. Sandeep S, for an exceptional session on smart financial planning under Skill Sprint 2025. Your insights into wealth creation management and financial security have given us practical takeaways that we can apply in our personal and professional lives. As a special thanks to our JCA leadership, organization team, and every participant for making this session engaging and interactive. Your support drives the success of skill spends. Let's stay committed to learning and adding new skills. See you all in the next session. Thank you.
Thank you, Savit.
Thank
so the
you.
learning never stops. See you next week for the next. Thank you.